Time. Let us go ahead and get officially started and welcome you here to our webcast titled Three Strategies to Protect and Grow Your Retirement Nest Egg. Before we get started, we have a lot to cover and a lot of things we're going to show you. If learning about building and managing your retirement portfolio is something that sounds good to you, now is a great time to turn off all those distractions, right? We don't want you trying to multitask, spend 45 minutes to an hour with me looking at how we're going to build that foundation of growing your portfolio. Close your door, turn off your cell phone, or at least put it on vibrate. Close any windows that are open on your computer, whatever you have to do. Take some good notes, grab a beverage, an adult beverage if you choose, that'd be great. But we want to stay focused and give full attention here because I'm hoping that you'll walk away with some good information today. First, let me introduce myself. My name is Jim Penna. I am the manager of retirement services here at VectorVest. I've been at VectorVest for about 14 years now. It's been a wonderful time here, and I came down from the Connecticut, New York area about 15 or 16 years ago, and I started at VectorVest shortly after that. And it's been a great time. Prior to that, I worked in the securities industry as a market maker for a large trading firm. I spent some time before that on trading desks for smaller brokerage firms. I took my Series 7 way back. I have to date myself here, way back in 1992 when I first started in the industry. And what I like to warn you guys about is in a lifetime before that, I was actually a police officer in Connecticut for just under 10 years. So if at any point during the webcast it sounds as if I'm telling you what to do, I do get passionate about this, and that's kind of where it comes from. So be patient with me. But again, that's just a little background for me, and I'm very glad that you guys are here. I hope everyone is staying safe and staying healthy. Now, the reason we're here is because we want to help build that foundation. So as we begin to do this here at VectorVest, I've had many conversations with our founder and mentor, Dr. Bartolito, who created VectorVest a long time ago. We've been around for quite a while. And when we used to actually go out on the road for our seminars and our educational things, I would talk, and still do, talk to, whether it's email or on the phone or whatever it might be. And I was having a conversation with Dr. D about the things that our customers would talk about with me. And in some shape or form, and not always exactly phrased this way, but the question always comes up when people talk about retirement is how do I keep from running out of money in retirement? How do I keep that safe, steady cash flow? So as I'm having this conversation with Dr. D, he looked at me and said it the way only Dr. D can. He said, James, he calls me James. He said, James, tell him just keep making more money. Just keep making more money. And so that was the beginning of a journey for us to bring to our customers and our subscribers this belief that you can retire with peace of mind, knowing that you can steadily grow your portfolio, generate income, and preserve your capital. So that's our goal here today, is to at least lay that foundation for you so that you know that it's possible to do. We believe that a secure retirement is one in which you have enough income to live the life you desire. Now, this is kind of the old cliche of, buying a nice sailboat and sailing around the world. And these nice folks made their money at VectorVest. You see, they named their boat after us. Okay. We also believe that secure retirement means that work is optional and retirement is affordable. Whatever it is you want to do, sitting on your front porch or playing golf or whatever it is that you want to do. So we believe that you can achieve that, and we're here to help you do that. So when we talk about that peace of mind in retirement, we break it down to what we call the three P's. We start with profit. When we talk about profit, what we're simply referring to here, and I'll dig deeper into it as we go on, what we're referring to is finding good quality, safe stocks to reside in your retirement portfolio that can grow. Capital appreciation is what we're looking for with the right stocks and the right risk management techniques in place. The next P is provide. And when we talk about provide, we're talking about not just growing your portfolio, but also understanding and being able to generate a very safe, steady cash flow, for income. And then finally, and as I'll say many times in the next hour or so, is that the most important part of all this is to be able to preserve your capital, to preserve your net worth. Because if you're not able to do that, the other two fronts that we fight this battle on will be lost if you're not able to preserve and be prepared. So when we talk about capital appreciation, now no stock or no portfolio goes straight up all the time, but what we want to avoid is that roller coaster where you're never comfortable, you're never sure where your portfolio is going next. We want to see a nice steady climb on that equity curve of your portfolio. When we talk about provide, what we mean is we don't want a couple of random dividend stocks where some income may trickle in here and there. What we want is for you to have that safe, steady cash flow. And then again, most importantly, you need to go from being unprepared to handle times like we've just seen in late February that we're seeing now. And you must be prepared to preserve and protect your capital. So that's really the core of what we're going to do today. We're going to talk about these three fronts, as I call them, in our battle to get to that peace of mind. Before I do, it's always fun to make sure that, or important, fun, it's important, first of all, to interact throughout our time here. So I'm going to ask you some questions as we go through, but I want you to right now type in just a couple of words. You don't have to overthink it. What's the hardest part about preparing for retirement, or if you're already in retirement? What are some of the hardest things that you're finding so that it's good to have a feel of what you guys are looking for and what you're looking to accomplish by being here? And so Ken starts off, he says, preserving capital. And yeah, that's important. Dalver says knowledge of what to do. And that's important because you have to have a process or a plan in place, right? There's a process, there's a technique that you must have. Otherwise, it's just not going to work out for you if you don't have that knowledge or plan is the way I'll do that. Greg says cash flow he needs. Lejos, I hope I'm saying your name correctly. Steady income. Ashok has a great reducing drawdown in markets, and you're in the right place for that one. We're going to talk about that one later on. Okay, and so these are flying by pretty quickly here. Right, Bill says how much you will need, taking into account considering inflation. And Bill, there's a lot of things in retirement that you can control. There's a lot of things you can't control. Right, so that's kind of where the where the quote from Dr. D about just keep making more money. That's what we want to focus on. Preserve and increase, Bill says. So yeah, I think you guys, there's a lot going through. I can't read them all, but you guys are looking at the right thing. I think you're in the right place today, from what I'm seeing. And so let's go ahead and jump right in and do this. So I'll dig a little deeper from the three P's. Let's be more specific. Capital appreciation is number one. That's the profit side. We're going to talk about finding good quality stocks that grow your portfolio. We're going to discuss income, generating that safe, steady income. There's going to be two parts to this, right? There's going to be dividend portfolios, and there's also going to be the power of using covered calls as a way to generate income. And then finally, we're going to address the all-important capital preservation side of what we do here. Okay, so we're going to walk through all of those things. Let's start with capital appreciation. So when we talk about this profit side of that triangle we looked at, we have to understand that capital appreciation comes from owning companies with consistent and predictable financial performance. And I like to hammer home the idea, what two better adjectives are there to describe the type of stocks that reside in your retirement portfolio that are better than consistent and predictable? I can't figure them out. So we want to be able to build that portfolio, or to use a baseball analogy from Dr. D's quote where he says good portfolio management starts with buying the right stocks. And I'll use several baseball analogies as we go through, but what caught me with that statement from Dr. D is I look at it as fielding a team, right? And that's how you should look at your portfolio. You're building a roster of players, and you're putting a team on the field, and you're going to win when you have the very best players on the field. Now, again, I grew up not too far from Shea Stadium, 1969 World Series champs. So when I look at my portfolio, if I'm looking at stocks, I think of having Tom Seaver or Nolan Ryan, Tommy Agee or Cleon Jones on my team, and that's how you win. You put good players on the field, and so it's the same, I believe, in your portfolio, and that's what we look for. To do that, we believe that it begins with investing in safety first. So when we're talking about that portfolio that is dedicated to capital appreciation, we are talking primarily about safe companies more than anything else. Because, again, to continue the baseball analogy, while it's fun to hit the home run, what happens to most home run hitters when they don't hit a home run? I just gave it away. Yeah, and Ed says Yogi Berra was there too. Yeah, he certainly was. Um, right, they strike out, right? If you're trying to buy, the $2 stock that's going to go to $50, that's fine. There's nothing wrong with that, by the way. But that's not what our objective is here today. We're looking for that safe strikeout. We don't want you striking out. We don't need you to hit the home run. We need that safe, steady movement. So what we do is we have a stock safety checklist. There are, in fact, 6 specific pieces of information that go into that analysis or assessment of safety for individual companies. These are the indicators that, or the information that Dr. DeLito used to funnel into the VectorVest program, into the formulas that he created that now give us our safety analysis in the program. And their earnings consistency, the company size, price behavior, business longevity, dividend history, and debt to equity ratio. I'm going to focus on these very quickly. Company size and business longevity. These are important things. The takeaway really for company size is just to understand that just because a company is large and been around for a while doesn't necessarily mean it's safe. So keep that in mind. Think GE when you think of how company size matters. It's a huge company, but these days and for a while now has not been a very safe company to be invested in. And then business longevity, Dr. D just described it as, it's the devil you know versus the devil you don't. So a company that the longer it's been around, that is taken into consideration when we assess its safety. Now, if you go out on your own and you look to find this information on your own, there's a good chance you're going to get buried by a whole lot of data out there, a lot of different, perhaps conflicting pieces of information. So what we've done here at VectorVest is create an indicator called relative safety. It's an indicator of risk, and it is just defined as, again, the consistency and predictability of financial performance. Those are the primary factors that go into relative safety. And for anyone who may be new to VectorVest, know that our proprietary numbers, our indicators, such as relative safety, are on a 0 to 2 scale. This is kind of the range we use. We're going to focus on safety that ranges from anywhere from the high range of very good to excellent. Okay, this 0 to 2 scale allows us to compare stock to stock and put them all on a level playing field. So it's a great way to quickly assess the stock. So when we go back to our checklist, what I want to do is walk through each one because it's such an important part. I just don't want to say, hey, relative safety is great, let's move on. I want you to understand what goes into that. And so let's start with a company called West Pharmaceutical. And this actually we start and end here because it's got all of the characteristics that we're looking for. I just put this together. This is from about a week ago or so. The relative safety of West Pharmaceuticals on May the 7th was 1.45 on that scale of 0 to 2. That puts it at an excellent rating. Well, when we see that type of number on relative safety, what we'll also see, and this is a 5-year look back on the graph, it's got the price, and then down below is earnings per share. So we said 2 of the key indicators are price behavior, which we see this nice, what I call the northeasterly direction of price and earnings per share. Right? That's what we're looking for. So price behavior and earnings consistency. So those 2 important factors come into play, and that's what you can expect when you see the relative safety number up where it is there. Now, West Pharmaceuticals also happens to pay a dividend. And you can see again on just this 5 year look back, it has not only paid but has grown its dividend. And for a long time, West Pharmaceutical had one little stretch, 1 year, it was a little over a year, where they didn't raise their dividend. And so they don't make it onto what's called the dividend aristocrat list, but they are a very reliable company. Their dividend continues to grow, and it's a very safe dividend. So this is what we're looking for in safe stocks, this type of behavior. Now, it's important to understand that a company doesn't have to pay a dividend to be considered a safe company or have a high relative safety factor. They don't have to pay a dividend. West Pharmaceuticals happens to pay a dividend. But the key is to understand, if that company does pay a dividend, that they darn well better continue to pay it and grow it, because there is no bigger black eye for a company than to pay their dividend and then suddenly have to suspend it or cut their dividend. Now, having said that, before anybody types in, there are unique times going on now. There's a lot of talk of companies perhaps suspending or lowering or whatever, to their dividends because of what's going on since February and with the coronavirus and all. That's in real time, so we're still assessing that. But the key here, and what segues into the next indicator in relative safety, is the debt to equity ratio. Right? Strong companies with strong balance sheets are more likely to be able to weather the storm, to these headwinds that we're flying into here. They're going to be able to weather them better than the stocks that don't meet these safety qualities. So a strong balance sheet with a debt to equity ratio that's favorable for the company is probably going to keep that company, if they do pay a dividend, in good stead with their shareholders. So that's the importance of debt to equity ratio. And these are all the things that go into a high relative safety stock. One of the best searches in our program is called ruler stocks. These are what we call ruler stocks that look like this, like West Pharmaceutical. Why are they called ruler stocks? Because the old saying was that you can take a ruler and just kind of connect the points on that straight line. Well, again, no stock or earnings go straight up, but you have that steady, again, northeasterly move. And so that's what we're looking for. That's the same on the earnings per share. Right? You just draw that line of a nice pattern on earnings per share and on price, and that's where the name ruler stocks comes from. So what happens when we go out and we focus on these high safety stocks and we build a growth portfolio? Well, right here, what I have is an example of one of the model portfolios we use in our retirement coaching group every Tuesday, and one of the models I like to use in our courses and other webcasts. And it uses, again, stocks from our search called ruler stocks, where just to make the list, the relative safety number has to be at least 1.4. And the earnings growth rate has to also be very strong. Now, this is 3+ years. It's plus because I started it in January of 2017, so it's about 3.5 years now. This particular portfolio currently is in cash because of the sell-off. The positions were liquidated based on our risk management and currently leave us with no positions because we're still in a confirmed down in the VectorVest program. So yes, I am not going to talk past this drawdown that you see, and I'll address that in detail in a little while. But here's what we have. We have a portfolio that's up almost 25% over the last 3+ years, even given that drawdown. Okay, now to put that may not sound like much to you, but it should. And to put that into perspective, I ran a quick test on the SPY or the SPX. I use that because we generally use the VectorVest composite as our market timing trend, but most folks will compare performance to the S&P. So the S&P 500 over that same time frame as our portfolio here is up just 8.43%. And that doesn't include today's activity, which got hit pretty good. So that puts it in perspective, so that we've got a pretty nice return. And again, I'll address that drawdown in just a bit. So what I'm going to do is ask you guys to go back into the chat box and let me know. And I know the answer to these questions, but I want you guys to stay with me. Which would you rather have? A portfolio of random stocks where you're not sure where you're going to land next and you have this roller coaster ride? Or would you rather have the steady climb that stocks like this would provide for your retirement portfolio? Okay. Right. Eric says high RS control. Ken says 3 times he wrote it. Ed, Trevor, and Les all wrote steady. Ruler stocks like WST. Yeah, and Bill says at my age safety. Yeah, and that's what we want to see. Okay. All right. So that's how we build our capital appreciation portion of our portfolio, is making sure we find the right stocks. Now, part of that, of course, goes with finding the right stocks at the right time. There is a technique and a management technique, and we want to be sure that the VectorVest program is telling us that it's okay. And we use a very, I'll call it prudent slash conservative entry signal into the market to buy those stocks, which is, for those who are familiar, it's the confirm call in the VectorVest program. Okay, so that's capital appreciation. Let me move on to the next front here, and I'm going to talk about income. And here, again, what we're talking about is generating not just some random flow that you have some money coming in here and there. I want to talk about, and I'm switching gears here just so you're aware, right? We've moved to the next front. We're going to talk about the second core strategy, which is income. And we're going to talk about two different parts, or two different avenues of income, if you will. So when we get to that provide section, steady income flow comes from both dividends and covered calls. So part one of this is going to be about dividend growth stocks. And Dr. D wrote in Stock Strategies and Common Sense, he wrote that the best of all worlds, and that is collecting dividend checks while prices of your stocks go up. And that comes from finding solid growth stocks that pay dividends. And he goes on to say that VectorVest is ideally suited to find these babies. And yes, he does write the same way he talks. It's great. So let's go ahead and talk about dividends. Let's talk about getting paid. Now you can go into Google and you could type in good dividend stocks. Here you get about 850,000 results if you do that. And what you're going to find is that whatever list you bring up is usually going to just sort those by the current dividend yield and just show you the highest yielding stock, as if that was the only characteristic that we cared about, and it certainly is not. So you try some of these other sites, and this one's kind of cut off, but you'll see the current dividend yield is the highest one, 32% yield, right? Same thing here, all sorted by dividend yield. Here at VectorVest, we believe there are far more important, more important characteristics than just the dividend yield. Dividend yield does play a part, but it's not the only part. So the characteristics of a quality dividend payer are found again in the VectorVest program. And what I have here is a spreadsheet from a search that we have in our retirement folder here in the Unisearch program. It's called Blue Chip Dividend Payers. I created this a while back through a special presentation that we did, and it focuses on the dividend information and these characteristics that we look for in a good quality dividend growth stock. So let me just walk through the ones that we believe are important. And the first three here in line are the three most important characteristics that, or at least three of the most important ones. And it's earnings growth rate, where you see GRT, that's the company's earnings growth rate in percent per year. Next is dividend growth. This is the history of the dividend growth of the company. The dividend safety. These are VectorVest numbers here. The dividend safety is a VectorVest assessment of safety of that dividend. This is the one indicator that's on a 0 to 99 scale. And we say anything at 50 or greater is favorable, and that's what we look for. So we need that dividend safety to be greater than 50. What that ensures us of is a fair and reasonable, favorable payout ratio. And what I mean by that is, what we don't want to have, if I compare dividend yield to earnings yield, what we don't want to see is a company that pays out dividends more than its earnings per share, or in this case, if I use dividend yield versus earnings yield. Right, so right at the top is Hasbro. It's got an earnings yield of 6.7, dividend yield of just about 4 as of just last week. And you'll see that's the case with all of the stocks. You can also compare dividends to earnings per share, the actual payout. You can do that as well. And then we have our YSG. This is the yield safety growth vector that takes into account dividend growth, safety, and the yield. And naturally, anything above 1 on the 0 to 2 scale is favorable. So these are important numbers when we look at that. Okay. Okay. So when we look at those type of stocks, when we find those type of stocks, let me just go back. T. Rowe Price is also a stock on here. I use this one because I actually own this in one of my more prudent accounts. T. Rowe Price is there. So I use that graph here to make a point on the power of a quality dividend stock. It's what's called a dividend aristocrat, which is an S&P 500 stock that has not only paid but grown their dividend every year for 25 years or more. Okay. T. Rowe Price, which was the number 2 stock on that particular list, happens to meet that criteria. Now this graph goes all the way back just 25 years. And you can see what I like to refer to as the golden staircase, just continuing to grow their dividends year over year, and that again the steady price pattern as well. And of course there's going to be drawdown. 2008 there was drawdown. The end of 2018 there was drawdown. Right? I don't even need to look at the time frame here. These good quality stocks, when I see the drawdowns there, I know exactly when that happened, and as most stocks are going to do in those time frames. So I do take that into account. Over here on the right, we have our control panel here that shows us the dividend safety on T. Rowe Price as of last week is up at 70, very strong. The dividend growth rate and earnings growth rates are strong. The yield is above 3%. That's kind of the line in the sand we use in that search. We want at least a 3% yield. And then we have the relative safety and the earnings per share numbers as well. But these are the important numbers to look at. There's another stock that is in one of our master portfolios for the retirement group, Kimbrly Clark. It was one of the few stocks that has made it through the sell-off and wasn't stopped out. But another dividend aristocrat, having that staircase just grow and grow, the steady price movement, and once again, all of the dividend information that we would need. Okay. So that's what we look for. The same way we look for those patterns and characteristics of a growth stock, this is what we look for in the dividend stocks as well. Right? There are very specific characteristics we need to focus on. Now, when we do that, okay, now this is a snapshot of our dividend paying portfolio. This one is 7+ years. This is a little bit longer than the growth portfolio. I like to take a longer look. When I do back testing and model portfolios, I don't like to go definitely not past the 7 years. I have 1, 3, 5-year, 7-year looks to get a good sense of how the plan might work through certain times in the market. Now remember, I could look at just 2015. If you remember that year, it seems forever ago. The S&P 500 was actually down. Same thing in 2018. So the dividend stocks, and this is just capital appreciation, by the way, this doesn't take into account the dividends. This portfolio is up roughly, we'll call it 13% annualized rate of return. And again, to put that into perspective, the S&P over that same time frame is up about 0.5% more. Okay, but again, what this doesn't include is the over $30,000 in dividend payouts that have been calculated. And I calculated that to the penny up until about 3 or 4 months ago. I think I made my case on how the dividends can grow in the portfolio. So I haven't kept up, but I took every position, the life of every position in the portfolio, calculated the dividends, and that doesn't even include reinvesting those dividends and taking advantage of the power of compounding. So when you add that in, again, roughly it's about an 18% annualized rate of return, and so it does outperform the S&P 500 there as well. Okay, so that I admiringly and lovingly call the blue chip dividend payer the most boring portfolio because it is very easy to manage. And again, before I'm done today, I have not forgotten. I will address how we take care of the drawdowns that we do see. Okay, so let's take a look then as we stay in the provide or the income portion of this, let's talk about our steady income flow, this time from covered calls. So we're in part two of income now. I, I'm sure you guys are familiar with Monopoly, right? And you put hotels and houses on your ownership deeds there, right? If you own Park Place and Boardwalk, you put hotels on them, you're probably going to win the game. But this is what covered calls is about, right? Think of it as charging rent to a stock that you own in your portfolio, charging it rent to reside in your portfolio. It is a great way to generate income. And in fact, the, the, the best definition that I've heard, whether you're new to covered calls or not, it's the most logical, the most straightforward, comes from a gentleman named Lee Lowell. He wrote a book called Get Rich with Options. He was a pit trader, I think, at the New York Mercantile Exchange, traded options as a market maker. And he wrote a book about several trades. One of those trades was covered calls. And I won't read the entire thing to you here. You can read through that. But this is the portion I highlighted. Lee Lowell said, you have to understand there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. Okay, think of that. Somebody's going to pay you money today to take your stock away at a higher price. That's when you buy a call option, right? You own the right to buy ABC stock at a certain price by a certain date, right? And you pay for that right. It costs you money. When you sell the option, you get paid, but you don't get paid for nothing. You have to provide the stock if it is, as the reason they're called calls, if the stock is called away from you. Now, before I go any further, if there's anyone in the room who is not, an option trader or is brand new to options, if you take nothing else away from this hour that you're spending here, understand that you can do this. And not only can you understand selling covered calls, and I'm going to talk about buying put options as insurance for your portfolio, not only can you do it, I strongly, strongly believe that it is an essential part of managing your portfolio. It's very easy to do, and I'm going to show you the reasons why it is so important. Okay, but I just want to put that out there, that if you are new to options, we're going to talk about the two most basic, most popular trades there are: selling covered calls and buying put options as an insurance policy. Okay, so let's talk more about covered calls. Here's a quick description just for the definition for you. It's the simultaneous purchase of an underlying stock and the sale of a call of the same security. That's what's called a buy right. You buy the stock and you write or you sell the call option. That's synonymous. Writing or selling a call option is what it's called. It is a great way, if you have the right system and technique behind you, it's a great way to generate a very safe, steady income. And of course, you can sell call options against stocks that you already own as well. But we're going to focus on what's called the buy right now. Let me walk you through a very quick generic or theoretical anatomy of what a covered call is. So we go out, we buy 100 shares of XYZ stock. Right. Our objective here is to generate income, not because we think XYZ is going to 90. We're going to buy it at 60. At the same time, we're going to go out and we're going to sell someone else the right to take our stock away from us at a higher price at a later date. This is the expiration date. It's 45 days out. That's the life of the contract. We sell the 62.5 strike price. It's where you strike the deal. Okay. So as Lee Lowell's definition goes, we sold someone else the right to take our stock away at $62.50, and they paid us $2 per share to do that. What does that mean? It means my net debit now, or my cost basis for the position, is $58 per share. Okay, I got paid. I took in that $2, but again, I didn't get paid for nothing. So let's take a look at some what-if scenarios. At expiration, if XYZ is called away, right, or if it closes above 62.50, it will be called away from me. which is fine. That's my goal. What will happen? Well, remember, my cost basis is 58 bucks. That means I profited $4.50 or 7.7% in just 45 days. Now, that may not knock you off your seat if you're an active trader. But if I told you there was a dividend that paid every 45 days, paid you 7.7% return on your investment, you would bang at the door to get that stock into your portfolio. So remember, this is part two of income here, and you're able to generate that kind of money. It adds up, believe me, very quickly. So what if the stock is below 62.50 at expiration? Well, remember, our cost basis or our break-even point is 3% lower than that original price of $60. Okay? So that builds a cushion for us. So we're usually going to go 30 to 45 days out, and we're going to usually go one or two strikes out of the money for expiration. There was a comment there. Okay, so if the stock is below 62.50, and this is all at expiration, I do have a cushion, 3%. Stock could go sideways, it could go down just a couple of percentage points, and I could actually still make money. Now, if the stock falls below 58 at expiration, losses will occur because you have to remember, the selling covered calls against stocks you own adds no risk to your position. There is no added risk involved. Why? Because the inherent risk comes from the fact that you own the stock. So if the stock falls below 58, then yes, losses will occur. And of course, you're going to have management techniques just the same way you would as you own a stock. You have stop criteria, you have an exit strategy, and our covered call techniques do as well. So part two of collecting income is a safe, steady cash flow from selling covered calls. Let me give you an idea of how powerful that can be. I talked about a retirement income portfolio, we call it in our coaching group. Advanced Micro, this run on AMD, and I think there were actually trades earlier than this, but to show you the power of this, it began back in June of 19, so not quite a year ago. Okay, not quite a year ago, and I'm not going to get into the specifics here. We're buying shares of the stock. We are selling usually one or two strikes out of the money, usually 30 to 45 days out. But I want to give you an idea of the power of this. On 6/18 of 19, we began this run. 300 shares of AMD, we sold 3 covered calls. Using our technique, our risk management technique and our profit taking techniques, we closed this AMD trade for a profit of $603 just 31 days later. That was a 6.8% return on investment. We did it again. Just a couple of weeks later, on August 6th, we did it again, and we were able to pocket another $600 in 28 days. We had other positions in that income portfolio. AMD found a bottom and started working well. It's a great stock for this. We bought another 300 shares. We made $417 in just 28 days. Following the technique, we did it again in December. This time it took us 10 days to make $582. It's another 5%. And then this slide I have a little fun with. The last time I did the presentation, it was right before the sell-off in the markets. So that hadn't occurred yet. And we had just opened up another 200 share AMD position. We sold 2 covered calls against it. And I put on the slide, because at that time it was an open trade, I said, I'm not sure where it's going to close, but we were up at that point $375. So it was an open trade at the time. Well, I can happily relay to you that on February 18th, which is just 2 weeks later, we closed that position for another $538 profit. Okay. So that's how we do the income. There are some nuances that go into that. On the downside, we do put a stop order on the underlying stock. There is a risk management technique. To close it out, you would simply buy back the call and sell the stock. You can do that simultaneously in your broker. But when we do it right, when we follow the process, we do have um, a history of more winning trades certainly than losing trades. And when they're managed correctly, it's another great source of income into your portfolio. So that's core strategy number two, income through dividends and through covered calls. Which leads me to, again, what I believe is the most important part of these three core strategies, and that is capital preservation. We're going to talk about protective puts. So remember, I said earlier, don't shy away. Don't put your hands up and say, I don't understand options, so I can't do this. That's not the case. You certainly can and you need to. So, protective puts. It all comes back to, for my fellow Connecticut Yankee, Mr. Mark Twain. And before anybody who might be from Missouri types in he's from Missouri, I understand that. But he did live in Connecticut, and I believe he's buried there in Connecticut, so he's a fellow Connecticut Yankee. Well, anyway, he wrote, don't just sit there and worry. Be proactive. Do something, anything about what's worrying you. Okay, so that you can gain information, focus, and control. It's just the perfect quote for what this entire core strategy is about. You can't just sit there and do nothing. It is incumbent upon you to manage and secure and preserve your net worth. Okay? There are ways to do that. Yes, you can just sell your stocks. You can put a tight stop and get out of the trades. Yes, that's always an option. But you you know, there are a lot of other ways to do it. There are a lot of tools available to you. Right? When a contractor or a carpenter goes to build a house, he doesn't show up with just one tool, right? He's just come with a screwdriver. Right? He's got an entire toolbox. And that's what I want to talk about now. And it's just a great quote. And I love the second half. I've suffered a great many catastrophes in my life. Most of them never happened. And you don't have to live through the catastrophes if you are proactive. In other words, in other words, you need to be prepared to protect your assets. How do we do that? Well, to reduce risk, we buy put options to protect individual stock positions, or you can protect an entire portfolio by buying put options on an index such as the S&P 500 using the SPY ETF. A quick review of what a put, so I'm telling you you're going to go long a put or you're going to own a put. Right? What does a put option mean? It means you buy the right. This one we're paying for. We're not getting paid. We're buying the right to sell our stock at a certain price by a certain date. That's the contract. Or, where the name comes from, I buy the right to put my stock to someone else. So here's what happens. The x-axis here is the stock price. As the stock price goes down, the value of a put option rises in price. Okay? As the stock goes down, the value of the put rises, which tells us that it is an insurance policy. When my asset is damaged, my insurance policy will help to cover that damage. That's all you have to look at it as. You insure your home, you insure your car, your life, your health. Heck, my wife and I have insurance on our two dogs. Right? So you can certainly go out and insure your portfolio. Let me walk through a quick case study to show you how this works. I don't want you to worry about the time frame or the stock. It could be ABC stock at any point in time. It's the concept I want you to take away here. Texas Instruments. Let's say you really wanted to be defensive on Texas Instruments, and I'll talk about some of the strategic reasons why you should be at certain times. Well, if you want to protect a profit, whether you bought it down at this confirm call or this one here, whichever, right? You have a stock that has gone up in price. You have an asset, and it's up to you to protect it. So you could buy a put option. Now, the price of the put or your insurance depends on where you set your strike price, and this is up to you. You set the price as the buyer of the put option. So you have a choice. You can buy if you buy a good insurance policy, a car insurance policy, let's say, and it's a good one, and you pay more money, usually it means you don't have a deductible. Think of your put option as that. The stock is trading around 120. I could buy what's a 120 strike put option. It gives me the right to sell my stock at 120. That would be a better protective insurance policy. I could also buy a 115 strike. It would cost less, but I'd have a little bit of a deductible if the stock were to fall. So that's kind of what the idea behind the put option is. I buy the right to sell my stock in case it falls. So I can cover the damage. So here's the case study using that scenario in mind. Let's take a look. You bought TXN on November 24th. There was a confirmed up signal. Maybe you bought it way back here and you got even a bigger return. Either way, you own a stock that has moved up in price. In fact, on this date, the stock was up roughly 20% or $2,000. Now, here's the mindset I want you to have when you consider this. Yes, you may have bought the stock somewhere in the, just under $100 and it's trading now at 120. So you can say, well, I own the stock at 100. Or heck, maybe you bought it way back on this one and own it somewhere around $85. Here's the mindset I need you to have. Forget this price. I understand that's your cost basis and your break even. But if this stock has gone to 120, in my mind, I now own this stock at $120 a share. That's my stock. I own it. And I'm not willing, listen, we could give back some of it, but I'm not willing to give all that back because I wasn't proactive. That's the mindset I want you to have when you think of this. So because we do in this particular case study, we do our due diligence on every stock we own, and we know that earnings are about to be announced in about a week or so. So we have a window of about a week to 10 days where you want to take advantage of understanding insurance on your position. So you have a week to buy protective puts to protect the profit, the unrealized gain that you have. So in this scenario, we'll go out and we'll buy that 120 strike, which gives me the right to sell my stock at 120, no matter where it goes. Go to $10 a share. I can sell it at 120. I'm not going to. I'm going to sell my put for a profit, but I could sell it at 120. I'm sorry, it cost me $423 to do that. $4.23 per share for one contract. $423 to protect roughly a $12,000 asset. So what happens? Earnings are announced, the stock gaps down. What happened was my put value is now $1,128, so roughly $700 profit on the put option, which offsets significantly the loss on the underlying stock. My insurance policy has covered my damaged asset. Had you not bought insurance, right, your gains before earnings were $2,000. If you had done nothing, you just gave away $1,000 because you were not proactive. You just gave away half of your profit. Had you bought insurance, however, you would have offset it by $700. You would have lost $300. And again, if that's not, a knock you off your feet kind of number, picture that in a portfolio of 10 or 12 or 15 stocks, quarter over quarter, year over year, if you're able to protect. And I know someone's going to type in, well, what if the stock goes up? It's costing me money. Right? It's going to cost me money if the stock goes up. I'm going to lose money on the put option. Well, if the stock moves sideways or moves up, you sell your put option and you will suffer a small loss. But let me ask you this, and I can tell you from my own experience, right? On the 18th of every month, Geico Insurance takes my car insurance right out of my bank account. I don't look at that transaction and get angry that month I didn't crash my car that month and I didn't need the insurance. Right? So I'm fine with paying the premium so that I can sleep better at night, knowing that if something does happen to my car or one of my kids' cars, which has happened, unfortunately, we were covered by the insurance policy. So you need to look at it that way. So you drastically minimize your losses, and over time, you mitigate those drawdowns we saw in the earlier graphs. So I'm going to take a quick sip of water, and I'm going to ask you guys. And Michael, yes, that is less the premium paid. That's the profit, the $700 I showed. Type in real quick so I know you guys are still with me. Is Protection or no protection? Which would you rather have? Yeah, and I knew the answer, but again, I want to make sure you guys are still with me. Yeah, we have to be sure that we are able to preserve our net worth. That's the whole takeaway there. Now, let's talk for a minute about protecting your overall portfolio, not just for an earnings report, but something more important. Preserve capital. This, from that same, I said earlier, I used a slide from an earlier presentation, and I used this slide as well, and I thought it was a perfect scenario to make my point. In this case, when the market was still up, the sell-off hadn't come yet, and I was trying to hammer home the point that you must be prepared to protect your portfolio at all times. Don't be blinded by this straight upward move of the overall market. You had to be you had to be aware of that and protect those unrealized gains that you were seeing. And we were starting to see headlines, and there was reason to start to worry and feel as though you had to be proactive, right? I didn't want people to be blinded by the fact and think that the market just goes up all the time. And I said, I don't want to hear about that. And I zoom out on this very same graph unless you're willing to talk about what happened in October of 2018 when the market sold off 20% in just 90 days, right up to Christmas Eve, right? And then what happened there was it took a year to get your money back if you do nothing, right? Assuming that you've done nothing here, right? You lose 50% of the value of your portfolio. Your portfolio now has to double just to get back to even. That's time use of your money that's just gone, and you don't need to do that. So this was all before the sell-off. So as I was making my point, we know what happened, and the sell-off came on on February 28th. We got a confirmed down call in the VectorVest program. And if you wanted to be even more proactive, we got a DEW down. It was only 4 days earlier, but a huge move in the market, a DEW down signal, which is another one of our prudent timing signals, way back here. This is the strategic time, the clear time to become proactive and protect your portfolio. So I zoom in on that time frame and let me walk through the scenario for you. On February 28th, the confirmed signal went down. Time to be proactive. Place your insurance policy on your entire portfolio, not the individual stocks. Right? That's why we use the SPY, because it covers a broader market. So you buy one, and again, I'm just using one as the example. You buy one SPY March 296 put. Why did I choose that? Because that's right around where the SPY was trading. So it was an at-the-money put option. And yes, it cost me $14 per share or $1,400 to buy one contract. Now, this is my entire portfolio, and we're talking about a theoretical portfolio is usually of 100 grand or maybe a lot more, maybe less. Doesn't matter. It's all relative. It's 10 million to you. If it's your money, it might as well be. So we buy one SPY March 296 put. What happened? Well, we went out to the March expiration, and again, theoretically at expiration, well, not theoretically, the actual price at expiration was $67 per share. Now, I'm not saying you would have gotten out right at that price on expiration date at 5 minutes to 4 and captured all $67. My point is that at any time during that drawdown, whether it was here or even here or here, you would have greatly mitigated the drawdown in your portfolio. In fact, you would have made over $5,300 or roughly 380% return on that insurance policy. And if the market didn't crash and you lost $600 or $700, that's okay. That's okay. You can't look at it as, boy, what a terrible trade. I lost $600 while my portfolio at least stayed steady and then continued to move up. One of our customers, Elaine, he wrote a note in this, just so you guys know, I speak for my colleagues, I think when somebody writes something like this, it makes us feel pretty good about what we do here. And he wrote, Jim, because of your teaching, I hedged my portfolio. This was in January of 2018. For those who remember that, it was a severe, very fast market sell-off, but we were warned by the confirmed call. And Elaine was taking one of our courses, and he spent under $1,000 on insurance. And it netted him back $23,000. And again, if you don't remember that, this is the sell-off. The S&P was close to $290, and just a couple of weeks later, it traded as low as 250. That's a huge move, very fast move, and if you were prepared, that's what you can have in your favor. So these are the three core strategies we believe every retiree must know to build and manage their retirement portfolio and grow their nest egg. Just to recap, we talked about the growth portfolio focused on high safety stocks. We said it was roughly a 24 and change percent return. We put it up against the S&P 500. We outdid it 3 times over. And I just want to remind you, I didn't speak over this or ignore this. We were able to mitigate using those techniques. Our dividend growth portfolio, same thing. When we add in all of our dividend payments, we're able to still outpace the S&P 500, and even more than this, because this does not reflect the management techniques that I went over. We talked about a great way to generate a safe, steady income on top of dividends, understanding the covered call, understanding buying an insurance policy on an individual stock, and then finally I talked about the power of protecting your overall portfolio. This is the slide I just went through. So when we talk about peace of mind, remember, profit, provide, and preserve. 3 different fronts that we fight this battle on. We want a steady climb in our portfolio. We want a safe, steady flow of income. And then we don't certainly want to be unprepared. We want to know what to do and when to do it when it comes to protecting our portfolio. So we believe those are the 3 core foundations that you need to understand to build and manage your own portfolio. And towards that end, what we've done here at VectorVest, if you want to learn more about that, we have created a course called the Ultimate Retirement Solution. The online course to protect and grow your retirement nest egg. It's designed to take you by the hand and guide you through the method you need to grow and protect your account and retire with peace of mind. I want to just real quickly show you the 6 modules that in our digital course that we use, and I'll quickly talk about each one. First one's called Win Before You Begin. Lay a clear path to victory. If you don't have a vision statement, if you don't have clear goals and objectives, I can guarantee you now that you will not succeed in building and managing your portfolio. You have to have a plan. You have to have a process. And so in modules 2 and 3, we focus on both profit and provide by building a growth portfolio and the dividend portfolio. The A to Z step and the A to Z process. We have a checklist, know when to buy the right stocks at the right time, and set up your exit strategies and your risk management techniques. A lot of that has to do with managing your portfolio. We do that for both growth and dividend. Modules 4 and 5 will go into great detail on, again, these 2 basic and I think essential option trades. How to set up the proper covered call to generate income. It's very easy to do. If you buy and sell stocks, then you certainly understand the idea of a covered call. If you haven't done it, you just don't realize it yet. We'll talk about how to properly set up the trade and the trade management techniques. And then I just showed at the end of the presentation here the power of being strategically defensive, knowing and being prepared and knowing when to apply that preparedness will protect and secure your net worth. And then at the end, we'll take all the plans and we'll walk through the actual implementation, allocating funds, portfolio automation, and trading checklists or investment checklists that we need to apply. So it's a great course. Again, it's a digital course, but we give so much more. And here are some of the bonuses that you'll get if you decide to join us for this course. First, and boy, do I love doing these. These are the mastery support sessions. So each week, we activate the modules. You'll watch the module and learn the content of each module. But then we have a live mastery support session where when the market's open, so you can ask questions and we can apply it in a real world situation, help implement what you've learned in each module, look at what you're doing and help to guide you. And the great thing is, don't worry, if you can't make the live session later that afternoon or evening, it is posted and archived so that you can watch those later on. And you can even submit questions to a dedicated email bin if you can't make it, so when you watch the recording, your question can get answered anyway. So it's really great. It's a great part of the course, the live support sessions, to actually apply it in real world. Now, I alluded to earlier our Tuesday afternoon retirement coaching group. It's where we look through our model portfolios, we update them each week, see where we need to be proactive, check for earnings dates, sell covered calls, collar trades if we need them, and we do our weekly buy right portfolio. Again, we have a very specific process. And so for the life of the course, you're invited to this live Tuesday afternoon session. And once again, if you can't make it, we're going to archive it for you so that you can watch it later that day. Here's another great bonus module. This is after the course is done. My colleague, Mr. Ron Wheeler, our manager of options trading education, will do a great special bonus on trading credit spreads for monthly income. For those who want to take it to the next level, there's another income stream you can open with again, it's not hard to do, and they're very high probability trades. So that's another great bonus. On top of the live stream, here's my favorite one, right? I'm sorry, on top of the live mastery, there's the live stream training. So I get to walk up about 40 yards from here and to our state-of-the-art training center, and for the day, we get to walk through all of the modules live, again, while the market's open, where you can interact, you can ask questions during the session to solidify your understanding. We have an extended Q&A session, and it's really one of the things I really enjoy doing, being able to look in the program, go into the programs, actually see it in real time and be able to do that. So you get access to that. By the way, you get access to the course and this live stream for a full year after the course ends. So this is not something that just goes away, when you're done on the day. You get access to this for a full year. If anyone is interested in joining and you're not currently a VectorVest subscriber, we'll give you 60 days of our intraday program. It's the best tool to help you determine market direction, which is a huge part. I really didn't touch on market direction a whole lot here, but it is an important part of building and managing your portfolio. It'll help you find the right stocks, whether you're building the income portfolio, whether you're building the growth portfolio. VectorVest is ideally suited to do that and really does save you a lot of time. So, a lot of stuff involved here. The full retirement training course, the mastery support sessions. If you're not a subscriber, we'll give you 60 days. You'll get really, this may be worth the price right here, just the spreads for income trade. The live stream, again, is another. You get access to it for a year. You get all the information in one day. And then it's 60 days, but I guess it breaks down to the 6 sessions that you're invited to. Right, so once the course starts, you will get an invite from GoToWebinar for our retirement coaching group. And there's really, it's a great hour and a half we spend every Tuesday. There's great questions, great scenarios, and situations that we work through. So it's very helpful. So that's our URS online course. Is it worth the price? I think it is. The regular price is $9.95. Because you guys are here, we do have an early bird price of $5.95. You can go to VectorVest.com and /URS. That is now in the chat box. My friend and colleague, Mr. Ray Clark, just typed that in. He's been here, doing a great job answering questions in the back. Thank you, Ray. He just typed in that address. You can click right on that address and sign up. But because you guys were kind enough to spend the day here with us, spend this hour with us, if you order before we're done, and we're going to answer some questions and make sure you're clear on what we've talked about today, and if you're interested in the course, we have our fast action bonus. Order before the end of the webinar, and we'll take another $100 off it. Okay, so it's going to be $495 for the course and all of those things that go with it. Access for a year, the live stream, the live mastery sessions. Heck, folks, it's one profitable covered call trade. That's all it is. Now, they say there's no such thing as a risk-free trade in the market, and they're right. There is no risk-free trade. However, taking this course is risk-free because we're going to offer a 100% money-back guarantee. Once it's over and you've shown that you've put some time into it, if you're not satisfied, we'll gladly give you a refund for the course. So it is ultimately a risk-free trade. Okay. VectorVest.com/URS. The question I'll ask, or more importantly, you should ask yourself, what will it cost you if you do nothing? How much money will you lose? How much potential profit might you miss out on? How much time and energy will you spend trying to do this on your own? And then you might ask yourself how life might be different if you do this and it actually works. Okay. So VectorVest.com/URS. You know, they say, when is the best time to plant an oak tree? It's 20 years ago so that you can sit under the shade and enjoy it today. Well, we know when the next best time is, and that's today. So it's never too late to begin to prepare or build or keep making more money in your retirement years. Order before, again, the end of the webinar. $4.95 is our fast action bonus. And I see some folks asking questions here. I know Ray's tagged some. Let's go ahead and try to answer those questions for you. One of the main questions, and a lot of folks are typing in, when does the course start? It starts, I believe the modules are activated. I believe it's May 19th or May 20th is when the course actually starts. So it's just next week. It's a week from now. Again, the modules are located in what's called the Digital Chalk software. They're archived there for you. By the way, there's a bunch of resources, slides, PDF slides. You can actually print them out. We even put them in both color and black and white if you want to print them. We have resource videos, help videos that are there. We have homework assignments where we actually, you can watch the video to walk you through step by step. So there's a lot of resources there. The live sessions begin on Friday, May 22nd for Module 1. And that's Friday because I think that following Monday is Memorial Day. So after that, every Monday for the next 5 weeks, I believe it's noon Eastern Time. In fact, I'm sure it's noon Eastern Time. We will do our live mastery session for Module 2, 3, 4, 5. We'll have the Monday bonus session on July the 6th. And then later that week, we will have our live stream session where you can join us for the day and have some fun interacting, asking questions, and seeing it all live as we can actually go into the program, actually place trades and do things like that. So it's a great time. Okay, so that's the setup. What I'd like you to do is, if you've clicked on the VectorVest.com URS, which Ray typed into the chat box, you can just click on that in the chat box, and what it will do is bring up this page. Now it's going to land on the summary section where it's going to show you that it's only $5.95. So if you're logging in there, please know you got to click the register tab, and when you click there and you scroll down, you'll see the buy now bonus that's currently in effect at $4.95. It's at $4.95. So if you have clicked there and you have joined, do me a favor, type in the chat box I'm in. Let me know that you're going to join us. I can tell you exactly what the next steps are going to be. When you do sign up, an email will come, and all of the directions you need to access Digital Chalk and to get into the course are all going to be there. Okay. And so that's what we want to do. Just click on that tab or just go to VectorVest.com/URS. So let me know if you've gotten in there. If there's any issues with that, we can go ahead and take care of it, and we'll try to answer some of the questions that are coming in. Eric had asked when it starts, so I think I covered that one. Eric, it's next week it begins. Neil asked, does this offer require a VectorVest subscription? It does not, Neil. If you're not a current VectorVest subscriber, we will give you 60 days worth of the program, our intraday program, for free as a trial period. Do you need the program after the course is done? You don't. listen, you're better off with it and it will help you tremendously, but you don't actually need the software afterwards. You can apply many of the techniques without it. Okay. Okay. So let's see. See if there's any other questions coming in here. Joe says, with all the instability in the market right now, I'm not certain now is the time to get into the market, is it? I mean, we never have gone through anything like this. Joe, you're right. Half of your question is right. We have never seen anything like this. I would argue that it is the exact time to take a course like this to understand and be prepared when it is time to get into the market. There is instability, and that is all the more reason that the process, the techniques, the risk management techniques that we teach are so super important. So I believe just the opposite. I believe this is the time to be prepared to get in the market when that time comes, and if you're already in the market, to be able to protect it. So I would look at it from the other side there, Joe. That's why this course is so important right now. Lan is asking, does protecting the portfolio with options work with the Canadian market? Lan, it does, but in all transparency, the Canadian option market is a bit less liquid than the U.S. market. So it's not as easily done to just find options that have liquidity and you're able to trade against. So while I will say there is the opportunity to do it on the Canadian side, it is a it is a little more what's the word I want to use? A little less liquid, so a little more difficult to do. But you can do it. You certainly can. And certainly all of the other concepts apply to any and all markets. I know we have folks from the UK, Australia. It's the same answer for you guys. The concepts of building and managing are all there. It's the option liquidity that can be a little off. Okay. All right. Nick says he's joined the options paycheck course already. Would this course build on that? And I do think so, Nick. It's a little different than the options course. Ron does come in and do a bonus module on selling credit spreads, but it goes, it's a kind of a different approach. To the paycheck course is all about generating income using credit spreads. What we're doing is building and managing an equity portfolio and understanding a couple of basic option trades to protect it. Right? Those risk management techniques and those tools that I talked about earlier are very important. So it does build on it in the sense that it gives you more of a foundation in your overall management of your net worth. Okay. Let's see. All right. Okay. That was the pullback. Eric was asking how bad was the pullback in your ruler stock portfolio? I showed I showed it earlier. Yeah, if you look at just the stock performance, our portfolio was still up 80% over 3+ years, or 20, just under 25% a year. 25% a year, by the way, versus 8.5% in the S&P 500. The drawdown was significant, but when you apply the other risk management techniques I talked about, we cut that in half. I don't know the exact percent drawdown off the top of my head, but I do know whatever it was more than cut in half by the management techniques that we use. Steve is asking, what times are the sessions and are they recorded to watch later if unable to attend? Steve, yes, the actual modules that I talked about, um, I'm going to scroll back here. I guess I got to go farther than I thought. So these actual modules are housed in what's called Digital Chalk. And you can watch those. They're activated. You watch them at your leisure. The the um, the mastery sessions that we offer are every Monday, well, except for the first one, which is Friday at noon. Every Monday, they're going to be at noon Eastern time. And the second part of your question, the answer is they are all recorded and archived in Digital Chalk later on that afternoon or evening, and you'll have access to the bonus module, to the live stream, to the 6 sessions of the retirement coaching group. All of that is there. If you miss any of it live, you have access to it. Okay. All right, great. Stephen, great. Stephen says that he's in. Yes, Stephen, you will get. You got give it a little bit of time, but what you will receive is an email with all of the instructions and information you need to get into Digital Chalk and start your the process. Um, so keep an eye out for that email. It doesn't come simultaneously as soon as you enter. It takes just a little bit of time, but you'll get an email with all of the information that you need to get started. And so, we'll see you live on May 22nd, which is just, just a little over a week away. We'll have our first live mastery session. But prior to that, you'll have access to Digital Chalk. You'll be able to get in there. But great to have you. Thanks for signing up. Brian, you can go through the. Brian's asking, can you go through the entire course in the recordings, or are there parts where you have to be live? Brian, the fact is you do not have to be live for any of it. The modules are there for you. They're activated and available to you. The live mastery sessions, even those are recorded and archived for you as well. So you don't ever actually, even the live stream, you don't have to be there live. That will be recorded and available to you as well. So all of that will be there for you. All right. So I'll hang on here a bit for see if any other questions come in. Stephen is asking, what is the elite price? If you're an elite subscriber with VectorVest, the price of the course is $9.95. That's the regular pricing. You would receive it for $497.50. Stephen, you would have to, I believe you'd have to call in to get that. Now, keep in mind, if you sign up now, the process will already start pouring money into your pockets because you'll save $2.50 by signing up at $4.95, which is the current buy now bonus. So already you're getting a dividend payout of $2.50 if you sign up now. Neil has, I think, a great question. What would this course be for someone who is retired? Neil says he's currently in his mid 40s, and Neil, I think this is the absolute great time to be planning and building and managing your retirement portfolio and understanding the important things you need to consider. I joke all the time. My goal someday is to have a room full of 23 or 25-year-olds in a retirement course like this. I try so hard to get my kids interested in the market. One of them is starting to a little bit, but it's hard to do. I wish I could have a room full of 23 and 25-year-olds, whatever. But the short answer is no. It will help you out if you have a portfolio, if you have a nest egg, anything in the market that you're looking to grow and protect. This is the place for you. All right. Give it a couple more minutes, see if any other questions. I don't know if I'm missing anything here. Okay. All right, Neil, great. Thank you. Hopefully we'll see you in the course. Again, if you sign up, hit that vectorvest.com URS. Make sure you hit the register page and take advantage of that buy now bonus. Nick, right now already in the options paycheck course. Right now there would be no discount scheduled for this, but I'll tell you what you can do. Here's what I'll do. The short answer is no, but shoot me an email. Shoot me an email. See what I can do. No, no promises. Again, the short answer is no. There are no discounts, but we'll see. No problem. My pleasure. All right, so I'm kind of hanging around to make sure there's still a decent number of people still in the room. I want to make sure there's no other questions. Again, if you've typed in that you're in, let me know in the chat box. If you listen, you still have time. The 495 is the buy now bonus. We still have the early bird, which I think is good until Tuesday, next Tuesday at 5 p.m. if I'm not mistaken. So you still have time to join. If you're not sure right now, you have to check a schedule or whatever it may be. Just know that the early bird is still in place for. I can tell you exactly when. It's still in place for another roughly 6 days from now. Ends May 19th at 5 p.m. So if you still have if you're interested and you just need a little time to make a decision, you still get the early bird special. Okay. All right, folks. I think I'm going to go ahead and wrap it up here. If you have any other questions, type them in now. But what I will do is say thank you so much for taking the time and spending that with us here today. I hope to see you in the course or see you at a future event here at VectorVest. Please stay healthy, stay safe, and we look forward to seeing you guys. Thanks, everyone.